Hello, everyone. My name is Barbara Armstrong, and I am recording this session on a Monday, March 9th. We had some technical difficulties during the live session, but we had a lot we wanted to cover today, and I would hate for you to have missed it. If you are not following me in the land of X, I invite you to do so. My handle at Barb Armstrong CS. You can also now find me on LinkedIn, so feel free to find and follow me there as well, posting content on a regular basis that I hope you'll find informative and helpful. Please keep in mind that we are going to look at a lot of option trades today. So volatility has gone somewhat bananas. Chicken Little is officially out in the yard running laps. And there's a lot of nervousness in the market. But when volatility is high, it means premiums are high. And if we can see some interesting example setups, it might be an opportunity for us to take advantage of this high volatility. So we're going to look at some selling strategies today. And those involve options which carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges with Schwab, and not all will qualify. We will put all of our example trades on the Paper Money software application on the Thinkorswim desktop platform, which is a brilliant place to learn, hone your skills, make sure you understand your trading strategies before you consider trading in a live account. Know that one of the nuances or differences is that short positions will never be assigned early in Paper Money. That can happen in a live account. I've seen it happen in my own live account, and sometimes that can be a good thing, and sometimes it can be rather unsettling. So we'll discuss that as well. Okay, so let's get right down to business. And I want to start, and you know, Kevin Horner does a fantastic job at the market open. And you know, so, and if you missed that, it will be archived. But, you know, the S&P 500, whoops, I don't know what just happened there. Okay, let's close this. Thought I was closing that. Instead, it got expanded. So the S&P 500, this is the 100-day moving average, and it's now dropped below that with gusto. And, you know, from our high here, you know, we're now down, you know, it feels bad, but really we're down only 4% off the highs. But we have a breach of the 100-day moving average, and certainly a breach of this diagonal support line. And so that has a lot of people worried. There's a lot of geopolitical risk right now. You know, when we look at the NASDAQ, it looks a little better than when the market first opened. I mean, and now we're back above this diagonal support level, just peaking above, but it gapped down on the open today, and has kind of clawed its way back up. On Friday, it was sitting kind of right on this diagonal support line, and it just depends on how you draw your support line, right? But certainly not, you know, super bullish. When we look at the Dow, you know, like that's kind of a concerning line also, below the 100-day moving average, which had, you know, acted as a support level, broke to the downside out of this pennant pattern that had been setting up, and, you know, down 0.5 point today. When we look at our small caps, kind of more of the same, like below that 100-day moving average, which has Chicken Little, you know, kind of nervous. A lot of people are looking now at cash as a position, and there are times that can be a valid position. We had a few years ago where most of our account was in cash most of the year. And in spite of that, we did a lot of short-term bearish trades. That was the year the S&P was down 18% and the NASDAQ was down even more. But, you know, all of this kind of making people a little skittish, right? So down 0.5%, but it is up from where it opened. But, you know, it opened and it went way lower, and then has rallied. Okay, and then let's see where the VIX is at now. Oops. Oh, interesting, because when I last looked at it, it was back above 30. Like it hit a high of 35 today, and is settling back down dramatically. So that may change a few things for us, but certainly a nervous start to the market open this week. And when I first looked at it, it'll be interesting to see where it is now. When I came in, I looked at the public watch list. The only sector that was in the green first thing this morning was the energy sector. And now, you know, we have technology up on the day, healthcare up on the day, staples up, and energy. But of those ones that are up, you know, which one looks the most bullish? You know, certainly the energy sector, right? Right. Okay. Now, on Friday, I promised that we would look at a couple of trades, and I was asked a few times if we would look at our short verticals. And so when I bring up our short verticals, we have 4. One we just put on, and FANG is doing beautifully. We're up 70% on FANG. But the other 3, Mickey D's, Caterpillar, and Apple, are not looking so hot. So let's look at Apple. And you know, what is one of the things that is troubling us is that we put this trade on here on February 17th. And if we come back and look at the VIX on February 17th, the VIX was way down here. Sorry, the 17th. The VIX was here, and now it's here. And so, you know, volatility kind of works both ways. We had put on these credit spreads with the expectation that the stock would rise, and it did rise, but then it's come right down to basically where we got in. You know, today we have a bullish candle at a support level. It's, you know, we want it to stay above 255. We have 11 days to go. It is trading above that now. So we're going to take one hand and the other hand, and we're going to sit on them. And the reason that this is, we've had all this time decay, and yet we're still underwater on Apple by $64, is because of this increase in volatility. That's certainly a part to play. Now, in hindsight, you know, when we were probably up 40 or 50%, or, you know, maybe we should have taken the money and run, but we didn't. Okay, so this is where we are, and we're going to just continue to let it play out. Now, Caterpillar is a similar story. So here's our short put vertical. It expires in 11 days on the 20th, so a week from Friday. But we have this bullish engulfing pattern here. And you know, if we were to draw a line, change my drawing tool. You know, this is in this neighborhood of kind of this previous high. And so maybe it'll find support here. Now, if it doesn't, this is a long way to come. But in an average day, if we come and we look at our studies and we add average true range, which is the amount this stock has moved on average over the last 14 days, that number's over 20 bucks. It's currently $27.65 is the amount Caterpillar has moved on average in one day. So we're at $6.92. We have 11 days for it to move, you know, 40, just under 50 bucks. And is that possible? Well, totally. It took 2 days. Well, it took 4 days for it to move that far to the downside. So it's possible it could move back up. So we're going to sit on our hands on that one. And even if it just rallies for a couple of days, it might help us manage the damage. Now let's look at Mickey D's. Now, earlier today, I would have said just exit this trade. But earlier today, it opened down here. It was continuing to fall. And so sometimes a couple of hours can, you know, make a difference. Because I had put exit on this trade. And then Mickey D's is kind of the same. We put it on here. We had expected it to continue to go to the upside, because we had this kind of sideways pattern. It had broken out, was continuing to the upside. It's come back down, and it looks like today is a bullish engulfing pattern at a potential support level. And so we're going to continue to watch these. We'll look at all three of these again on Friday. Now, we did have a long call vertical on Boeing, and we had put 3 trades on Boeing. And back on this day, the first one we bailed on was the long call. And then we were stopped out. We had an exit in place and we were stopped out. But we're sitting down here. We had this bullish engulfing pattern on Friday. And, could this be now acting as a bearish harami? We're not sure. But, this would need to be above that 230 mark. And it's just not gone the way we were expecting it to go. We weren't down quite 50%. We're down 41% on this long call vertical. But man, oh man, this is, and part of the reason we're only down 41% is again because of that gift of volatility that's kind of pumped the prices up. But I think on Boeing, we don't have to wait until we've lost 50% to exit. I think this just didn't go the way we were expecting it to go, which was to continue in an uptrend. It's kind of got caught in this downdraft. And so we're going to exit this position. We don't have to wait until we're down 50%. Now, we're making a decision with the information we have at this time. Could it turn around and go up? It could. But could we lose the entire amount? We could do that too. If it had a big down day, we could be down way more than that 50%. So we're going to just say, hey, if I can get 160 for this, we've lost a little, but then we live to trade another day. Okay, and that was in our long call vertical bucket. So we put our exit in for that. And so those were the 4 that I promised we would look at. In addition, I was on the struggle bus with my system on Friday. I seem to have not gotten off that bus. But we're going to move our Boeing trade up to the Iron Condor group. And we put it in as 2 credit spreads. I like to call these trades a credit spread sandwich. Oh, that was Boeing. Sorry, that's our exit for Boeing. Okay, so we've closed that. So we're out of that one. That was in our long call vertical group. So with NVIDIA, we've made a whopping $25 on this, but you can see there are no little chiclets here. So we didn't put an exit in. So we opened the short call vertical at 44 cents. So we're going to put in an exit when, at 9 cents. So when we've got 80% of our max gain, we'd like to buy this back. So when that's worth 9 cents, we'd like to close it out. And that's just the top part of the trade. And then we're going to come back and say, okay, this is still at 48. So not surprising, it's down a bit today. So when this is worth, I'm going to round to 10 cents, we'd like to close that side out. So take our risk off the table. And so make that good till canceled. If I didn't remember to do that on the other side, let's see. NVIDIA, yep, these are both good till canceled. And this was a trade that we put, it expires March 20th. We put this trade on Friday. So if we want to show that on our charts. And our expectation is that this will stay above 170 and below 195 for the next 2 weeks. Okay. So that's our long call vertical. Now let's look at some new opportunities. And if we go to our bullish energy sector and we look at Chevron, because we've got such high volatility, when I was looking at this morning, I thought, hey, could I come back like kind of in the neighborhood of this low around 185 and maybe sell a short put vertical? Could we do a short put vertical, and could we do something like really short term, like maybe even just a couple of weeks? So if we come to CVX here, we're only 11 days out. Now, what's the risk here? Well, the risk is that if it does come down more than $5.60 and we're in the money, doesn't give us much time to recover. But, we've traded this is saying 237 shares, 1,000 shares, but we can see that on an average day, this trades heavily, 8 million, 7 million. What's it saying for today? Well, I'm not seeing today's volume yet. But, it's a heavily traded stock. And when we come here and we look at this 185, we have over 2,000 contracts and a bid-ask spread that's, just over 10 cents. So we're going to say, hey, could we come and sell a vertical and get enough premium? Well, this is a 250 wide spread. And if I look at 250 minus 64, that's $1.86. And I say, if I can get 64 cents and divide that by $1.86, that's a potential 34% return for a trade we'd only be in for 11 days. Now, could we come out further? We could, but we have a lot less volume. We still have a 20-cent bid-ask spread, but this is a lot of premium for a very short period of time. And so we're going to come in and say, well, if we're risking $1.86, we could do, if we did 3, how much are we risking? 558. So if we said, well, we're okay with risking that much, then we would come right click, create an opposite order, say when this is worth about 13 cents, we'd like to buy it back. So our example trading plan says when we have 80% of our max gain, and the most we can make on this is $64 a contract, we want to exit the position. Now, if you're looking at this and saying, example trading plan, what example trading plan? Well, I created a folder under, and this is, where I insert my little commercial to say, if you haven't subscribed to the Trader Talks from Schwab Coaching, you may want to consider doing that. So when you come here and come to playlists and then scroll down, I created a playlist, which is really a folder. And at the top here, if you're new to charting, I've got a bunch of mini sessions. There's, I think, 13 of them so far on candlesticks. But here's an example trading plan for short put verticals. And it just gives you a framework. It's like what to buy, when to buy, how much to buy, when to exit, both if the trade goes for you or against you, and then what are your routines. And then there's one here for short call verticals. So spoiler alert, we're going to look at a short call vertical opportunity also. And that's under the, Trader Talks from Schwab Coaching on YouTube. And this folder or playlist is called the Trade Management Mini Sessions. Okay, so back to our regular programming. So we've now put on a trade on CVX. Now, if we wanted to look at another bullish trade, we could look at bullish to neutral. We could look at something like Johnson & Johnson. And you might say, why are we looking at bullish trades? Well, this stock has been moving pretty bullishly, hasn't it? It's been using the 30-day moving average as a support level. It's flirted with it 1, 2, 3, now 4 times. But this didn't even generate a red arrow because it it traveled below but closed above and is moving to the upside again today. So could we come back and say, could we sell something around this 235 and just like go out for a short period of time? So I'm trying to take advantage of volatility, placing a very short-term trade. And so if we look at this and we say, okay, we want to sell a vertical, well, if we get 48 cents, I mean, it's not quite as rich as the last one, but 48 divided by 202, that's still a 24% return potentially for a trade we're in for 11 days. So if we say, well, I'm okay with that, so we could do 2 of these, we'd be risking just over $400, single order, first trigger sequence, right click, opposite order. We could say, hey, when this is worth, 10 cents or 9 cents, you pick, I'd like to buy it back. Take my risk off the table. So we're going to put that in our short put vertical bucket. So this is kind of sort of bullish, right? Because if it continues to go up, we have a profitable trade potentially. Or if it goes sideways, we have a potentially profitable trade. And if volatility continues to fall, we have a potentially bullish trade. But with such a short time frame, if it goes below our strike, we do have the gotcha on that is we have less time to recover. But, we have time working in our favor here because as we get closer to expiration, theta is really clipping along. So when we look at theta here, the value of this 235 strike is losing 17 cents a day just by the passage of time, where if we came out to April and I looked at that 195 strike, it would be 3 cents a day. Like, I'm looking to sell something, get paid a nice premium, and then have it decay rapidly. And the March 20th strike provides the rapid decay component. And so that's why if people are saying, like, why is she only going out 11 days? Now you have your answer. Okay, so let's look at JP Morgan now, seeing as we're in the J's. So with JP Morgan, this stock has kind of been going sideways, right? Now, some might say, I think you should take and move this line, because when I look at this and I play I Spy with my little eye, which is a very favorite game of people that like looking at charts, I'm just bringing up, is there a pattern that you see here? Do you see what I see? Well, what I'm seeing is a shoulder, a head, and a shoulder, and then a break below that support level. Uh-oh. And so, that's a bearish signal. And this has gone from 334 to 293. So this is almost a $40 range. In fact, it is a $40 range. So a technician might say, well, I'm expecting this to fall by another $40. And so if we're being conservative, we could say, well, I just think it's not going to go back above 295. So could I sell a short call vertical for 295? And then a strike above that. Okay. I may post that chart on X today as well. Okay, so if we come to our trade tab and we say, could we get back up above this old support level, which may now start acting as new resistance? So could I come up here to this 295 level? I'm going to lose 15 cents a day just on the passage of time. if I come back out here to March, the 295, I'm losing 25. I'm losing a lot more, right? And then, is this heavily traded? Yeah, we've got, at the 295 strike, we've got 1,300 contracts. So if we look at this and we say, okay, can we sell this vertical? And you know, we get 61 cents. Again, does that meet our requirement? Well, the 48 cent met our requirement. The 61 we were salivating over, because if I take 61 minus 250, that's 61 divided by $1.89. Oops. 61 divided by $1.89. So that's a potential 32% return before we consider our exit price. And so I'm going to take my single order. I'm going to turn it into a first trigger sequence. I'm going to make this 2 contracts because that has us risking, you know, almost $400. We're going to right click, create an opposite order, say, hey, when this is worth about 13 cents, I'd like to buy it back. Good till canceled. Confirm and send. So we're risking $372. We're going to put that in our short call vertical bucket. And then I thought we could come and look at Coca-Cola. Now, Coca-Cola, you know, we often don't look at. And why is that? Because volatility tends to be very low. It's a very steady eddy kind of stock. And we don't tend to have a lot of volatility. But could we look at something like Coke, which was going sideways? Like if I back this up a bit, it was going sideways. We have this big cup and handle pattern, and then it broke out, came down to a previous support level. And today we have this, you know, bullish engulfing pattern at a support level. So we could do a couple of things. Like, could we sell like the 81 or the 82 call and buy 100 shares? We could, but what's our problem is that we can't afford to do that because our max position size, we have like $7,700 in our account, but we can't have a position size of more than 5,000. So we could buy $5,000 worth and put in a target of, like, say, $81. So we could do that because we have $23,000 sitting here in cash. Or could we do another short put vertical, like at this 76 or below, with the expectation that this will hold? Or, you know, we could do both and compare. So if we look at this, if we just come 2 weeks out, you know, and do the 76 and the 75, we have almost 10,000 contracts here at the 75. Would there be enough premium? Well, 24 divided by 75, that's 33%, right? 24 divided by, what are we risking? $1 minus 25 divided by 75. So that's over 30%. And our rule of thumb is, if we're in it for, say, 25 days, we want to get at least a 25% return. We very rarely would do something where we only have 11 days. But we're trying to take advantage of this hike in volatility. And so we're going to say, well, we're risking $75. If I take 500 divided by 75, I could do 6 contracts here. And I'm going to come to first trigger sequence and say, hey, when this is worth a nickel, I want to buy it back. And so these are base hit trades. Like if this trade goes according to plan, not counting commissions, we would make 6 times 20, $120. So this is not having you on a private jet going to Tahiti to drink something out of a coconut. But if you were looking to generate income to help with grocery money or your travel fund or like whatever, this might be a trade. Now, it could go wrong. You know, we could be down $500. And that's the way this risk profile tends to go. So the most we can make, 150, most we can lose, 450. So we're going to put that in our short put vertical bucket. Now, and we're going to compare this to the stock trade. Now, what's the advantage of a stock trade? Well, a stock trade, if we look at Coke, it pays a dividend of 2.74%. So if we have it for a little while, we could end up maybe getting a dividend. Now, one of the differences between paper money and a live account is that you're never paid a dividend in paper money. Also, there's no guarantee, even in a live account, that dividends will continue to be paid. But if we looked at this and we said, well, where would we put a stop? Well, if we said, well, let's look at this 76.38, 76.35, a recent low. If we went 3% below that times 0.97, we'd put our stop at 74.05. And we're going to put our target at 81. Now we can buy $5,000. That's our max position size. I'm going to divide that by our current price, 77.46. So we could buy 64 shares. So we're going to come to our trade tab. We're going to right click on this line, buy custom with an OCO bracket. We're going to say, hey, if we could make $81, we're going to be happy campers. This is called a swing target because we're just trading it back up to the previous high. And then 74.05 is going to be our exit. 74.05. Confirm and send. Oh, sorry, we could buy 64 shares. 64 shares. I'm going to turn this firecracker into a paperclip. Click anywhere and it'll line these up. So we're looking, this is a 1-to-1 risk reward ratio, but there is no guarantee. If it gapped up, we could end out with more profit. If it gapped down, we could end up with a bigger loss. So we have to take that into account also. So this is a stock with a target, and we're going to compare this to our short put vertical trade. So we've done actually a fair bit today. So we've done a short put vertical on Coca-Cola. We're going to compare that to a stock position, which we, could take a little longer, or, it could be out before the short put vertical. Both of them have risk. We did a lot of very short-term trades, way shorter than we normally do. And why did we choose to do that? We did that because we had this opportunity with volatility being high, of looking at something with a short-term time frame that paid a higher than normal return. So we did a short call vertical, which is bearish to neutral on JP Morgan. We did a short put vertical on J&J and a short put vertical on CVX. And we decided to throw in the towel, take a smaller loss on Boeing. We were down about 42%, and close out our long call vertical on that. So that's what we covered today. I appreciate your patience. I appreciate your tuning into this. Please hit the like button, subscribe to this channel if you haven't done that already, and don't forget to follow me in the land of X. My handle, Barb Armstrong CS. Also, you can now find me on LinkedIn. Take care, everyone, and have an awesome day. Bye for now.